welcome to the virtual arena. It's Martin from Pollen.
Great, thank you very much, James. And yeah, that does seem like an eternity ago, but looking forward to hopefully events coming back online and in person in the hopefully not too distant. So thanks everyone for attending today. It's going to give you a little kind of background to who I am and what we do as a company, and then we'll get into some of the meat of it, which is really around sort of financial planning and financial modeling for UA managers. So it's really this sort of combination of what UA managers need to know about finance, and then also sometimes what finance guys need to know about UA. So this kind of works both ways. So what we do as a company, and James is right, it was 2014 that we got started doing this, is we provide credit facilities to app developers and game developers, which is a very, very efficient way to fund user acquisition. So it's basically using debt instrument rather than equity instrument to fund, and it just means that given in a positive UA cycle, it can be an incredibly efficient way to fund. So you're not having to rely on dilutive venture capital to put into user acquisition, and it's really just an alternative financing mechanic to use typically alongside VC. One of the great things is non-dilutive. So if in the scenarios you get bootstrapped, completely 100% founder-owned companies, it can be an very, very effective way to scale up without actually giving away any kind of control. Now the purpose is for doing these sorts of sessions is really to try and improve the financial literacy of app and game developers generally, but specifically with regard to user acquisition. And then it's very easy for sometimes these functions to get kind of siloed into UA teams and finance teams and product teams and so on as well. But we think the best outcomes work or happen when people work together. So our mission here is improving financial literacy and thinking about capital efficiency. So using the right form of financing for the right purpose. So we're going to start off with just kind of metrics and concepts, and we're going to be looking through a real financial lens here, not just the normal sort of user acquisition KPIs, but really starting to think, what do these mean in a financial concept, financial context. So we're going to kick off here, and I'm sure this is sort of, hopefully sort of very obvious to most people in this virtual room, but there's three key things that we care about from a financial point of view around user acquisition. And not surprisingly, first of all is the cost of acquisition. How much do I have to pay, whether that's whatever metric you're using, a CPI or an install or an event or an action, whatever. That's going to be down to your own app or game. How much do I pay? Secondly is ROAS. So I mean, the ROAS really it's around not necessarily the return, but at what point do I break even? So first of all, do I break even on my ad spend? And the reality for a lot of people is they don't. They're either the ad costs are too high, whatever. It doesn't work for a lot of businesses. But obviously, hopefully, most of the people in the room here, you're able to spend money profitably on user acquisition. So the first kind of lily pad we want to get to is do I break even? If so, when do I break even? Super important, just in terms of number of days to actually break even, because that's one of the things that's then going to really project out the entire trajectory of growth. And then ultimately, where do I go from recovering my money? What does that journey ultimately look like towards a final LTV? So we've heard or people referring to an LTV is more of a kind of North Star metric in terms of, it could take you 6 months, it could take you a year, it could take you 2 years to recover your ultimate LTV. So it's more kind of direction of travel, and you can kind of forecast these things out using some tools and so on. But you don't want to wait 6 months or 1 year to see a full cohort deliver before you want to go back and do the next one, because your company will be out of money and someone else will come in and done it. So the final thing about LTV then is how much to expect that user or that cohort of users to pay you. And again, think about the time frame. Time frame is super important. So all we're really talking about, if we're looking just through the finance lens, is this is just an investment equation. This is like, you know, pitching an investor and saying, hey, I've got this formula, and basically every time I'm you know, I invest $1 into user acquisition, I break even in say 20 days, and then I make an additional, you know, I make a total of 189. So I'm making like an 89% return in 3 months. So roughly a 30% return per month. You know, fantastic. So what we're really trying to do is to decant all of this just down into this basic investment equation. So, and then, you know, very, very important to model some of these outcomes as well. So what we're looking at here is really the number of days to break even. Now, obviously, break even is a binary point, but there's lots of signals up to that point. So developers, particularly game developers, often look at, you know, at what point do I make 25% of my ad spend back, 50%, 75%, you know, and because if you can track these points and you can model them against each other, then you're going to know, you're going to have some early signals as to whether cohorts are delivering. So you don't just wait for the break-even point and say, oh, I broke even on day 38. It's like, where was I after 10 days or 20 days or 30 days, whatever it may be, whatever the relevant time horizon is. And then you get some early warning signals that you can compare different cohorts against. So I'm gonna break out of this now into some tools we built. So I'm just going to tab between screens. So as James said, we've been doing this quite a long time, and we worked with, you know, 100+ developers, game developers, app developers, all sorts of different things. And we did a segmentation exercise a few years ago, and we found that some people were really benefiting from the financing and it was really working. And we had one that went from, you know, well, we've had, you know, people doing up to sort of 22 times revenue, I think, over a 15-month period. Was one of our best case studies. But we figured out a lot of people didn't have either the internal kind of knowledge or BI skills necessarily to model all of their metrics and really kind of read the tea leaves, if you like, in terms of what they were saying. So we've had these tools out live for a while. They're just completely free up on our website. We just want people kind of using them and plugging away to try and, you know, help figure out. So what I'm going to do here, and this is really for freemium. Okay, we're working on some stuff for subscription apps and so on. Obviously, the business model is slightly different here, but for anything with a freemium mechanic, then hopefully this should be fairly helpful. So, and it doesn't matter whether it's monetized through either ad revenue or in-app purchase revenue. So what I'm going to do here is I'm going to do two things. I'm just trying to build my curves, and what I'm going to be plugging in is just some basic retention data. How long do people stay active in my game or my app, and what does that curve look like? So you build a curve here just from, you know, just tabbing between these numbers to say, okay, this is my retention curve, and any analytics package is going to be able to help you figure this out. There's a couple of other things. So I need the net ARPDAU. So it's basically average revenue per daily active user. And again, you know, ARPDAU should be a pretty easy thing to get. Again, this is a snapshot. So this isn't a sort of like a, you know, it's like a traffic light point in time that says, you know, on a given day or in a given period, given month, whatever, what is an average kind of revenue figure for across all the different cohorts. And then the CPI, so whether it's CPI, CPA, whatever acquisition mechanic. So this is basically, say I've got a 40% day 1, 20% day 7, right down to 3% at day 90, and I'm assuming 0% for D180. The trick here is that if you get your longer term estimates out of kilter, like I say, I'm going to just estimate 1 or 2% at D180, the propensity to skew the results is much greater. So we would always advocate for keeping keeping it shorter and more certain, and not being too optimistic about your kind of longer term results. So with all of these things, there's a couple other fields I need. an organic uplift. So that's basically for every paid user I'm acquiring through directly attributed paid installs, I'm assuming I get a quarter of a free user here. And then also initial budget. So this we just use for cash flow modeling. The initial budget doesn't really matter what it is. It's just going to skew the shape of the graphs and the outcomes. But you have to have a number to start. And then there's other stuff you can do. If you've got fixed costs in terms of running a studio, you want to subtract from that. And you can reinvest anything up to, obviously 100% of your free cash flow. And then the last thing on here is in terms of monetization. So the key thing that matters when it comes to the reinvestment cycle is how long it takes to get paid out by the ad networks or the app stores before you can take that reinvestment. So in this case scenario, we've got 100,000 initial budget. And what we're going to be looking at is how we spend that money over time, how we recover and recoup that money over time, and then what does that mean for our overall kind of financial modeling. So what I'm going to look at here is first of all just ROAS. So I'm going to plug around. Maybe our product team's got had some great improvements and they've managed to improve the D7 retention from 20 to 25%. So if I right now I'm projected to break even day 16. If I can put say 5 points on here and I redraw it, I go from day 16 to day 12. So everything everything makes a difference. So these numbers will redraw and so on as you get more data into them. And again, if I put an extra point in my D90 retention, it's not going to affect my break-even days, but it will affect my overall LTV. So we go from ROAS here into LTV, and again, so you can see the whole kind of journey plotted out. So here, let's say I've got $1.20 is my base acquisition cost. I can see I'm breaking even on day 16, and then I will go on to ultimately get onto a trajectory where I'm gonna say get to 100 D110, where I'm making $2.48, $2.50, whatever you might want to say. So basically that's just an investment equation. I invest $1.20, I get my money back in 16 days, and I go on to make another $1.30 almost after a total of 110 days. Now, again, we would always advocate for doing an LTV cutoff. At some point, the curve gets so flat that it's not really worth thinking about anymore. So just work out, model the shape of the curve, and model how far you're prepared to let it run for in your calculations. And frankly, if anything comes in over and beyond that, it's just it's just gravy. It's going to help the overall scenarios. So what I'm going to look at now is so I'm going to model the cash flows, and this is what we see a lot of UA managers, if they're disconnected somehow from the kind of finances of the business, this is the bit that they miss. So every business is different. Very often, a lot of early stage companies, effectively the founders are doing UA and they're managing the finances. So that this might be like a really sort of close-knit problem. The bigger a company gets, there's more kind of segregation and silos between all of these different teams. So very, very often you have this idea of like a marketing budget is allocated by finance to user acquisition. And as a UA manager, you think, hey, my job here is to get the very best paying quality users for my allocated budget, and that's my KPI. And that may work for some companies. We think that's a flawed way of looking at it, which I'm going to come to talk about later. But the syncing up basically of finance and UA functions, I think in any app or gaming business is super important. So what I'm going to look at is basically, this is just like net cash flow in the company. This is me starting with 0 cash in the bank, and I'm going to spend my 100,000 over a 60-day period. So you assume it's a 60-day constant spend of whatever initial budget you have as a way of getting started. And then what we're doing here is we're modeling each cohort you're buying, and what that actually means in cash terms. So my monetization here was on iOS app stores. So we've got payment terms of anything up to 67 days later. So if it's the first day of the fiscal period, excuse me, on Apple, then you would be paid for those IAP revenues 67 days later, or up to 67 days later. Now, obviously, you could be paid, if you do it right at the end of the cycle, it could be 37 days later. So it basically, you know, averages out just over sort of, you know, 50, 51 days, something like that, in terms of average days before a sale, between a purchase is made and then the developer actually receives the funds. And this is different if you go to Google Play. The terms are a bit shorter. If you go to a net 60-day ad network, which is basically anything that's paid, anything that's earned in a particular month is paid at the end of the following 2 months later, basically. So if it's the end of January, you would be paid at the end of March. And so you can model the impact basically of the different payment terms on your ability to take that $100,000 and invest it into growth. So what we're looking at here is basically, if I look at the red line, this is me, you know, in this case, I get a bump from Apple on day 67, and then you see the spike every 30 to 37 days later, depending on the payment cycle. You take all the money you've got from Apple, and then you spend that over the next, you know, over the next cycle, or spend whatever percentage you're reinvesting. And what the top line is showing, that if you are say using your receivables to fund it. So this is all of the revenue that you can see accruing in the App Store, but that hasn't actually been paid out. And that's, you know, as a company, that this is what we do. So we lend money against these receivables. So if you were to go to a company like Pollen and say, right, I want to draw on my receivables, or my AR, as they tend to refer to it in the US, I want to draw against my AR, and I want to reinvest that money back immediately back. So the point here is, like, you know, you've got an equation, you know, you've got an investment formula that works. The problem is you just don't have any more cash. Once you've spent your 100K, that's it, and you have to wait until money comes in. So what we're talking about here is to treat these receivables as an asset. So all the money that you can see sitting in the bank of Apple or Google or Unity or Facebook or whoever is an asset. And if you can borrow against that and reinvest it into something that you know is ROI positive, then mathematically you will grow quicker. So there's no algorithms or AI here, it's just a mathematical fact. Now, obviously what will happen is all of these numbers will be chopping around and metrics will be chopping around. So the model is fundamentally flawed, because it doesn't assume for all of the different variations in CPI and different cohort behavior. But what we're trying to do here is to give you like a traffic lights model to say, like, does my UA in theory work? And if so, then help me model some scenarios where I can think in terms of how I'm going to fund this user acquisition, and how I'm going to make it kind of, you know, sing and dance for me. So this is the, you know, the analogy. If you want a very simple analogy, it's basically like this. Let's say you go into the slot machine in a Vegas hotel, and you find the machine that for every time you put in $1, it's going to pay you out $2. Question is, do you wait 30 or 60 days before you go back to the machine and you put it in again? Of course not. You want to be shoveling in as hard as you can until ultimately the machine is going to stop paying. And that's really the way we think about UA. It's obviously a massive oversimplification of it, but if you are able to reinvest into something you know is ROI positive, then it's just a very, very frustrating thing to not be able to continue to spend as you want to be spending. So there's a couple other tabs in here I'll show you, and feel free to explore these on our website anytime. They're there to help people figure this out in terms of just planning their financials. There's something around revenues here. You know, just total installs. So if I go, I want a cumulative install, you know, just using this money efficiently and recycling it in an efficient way, you know, can mean that for as long as the user acquisition trade is open, this is going to be a very effective way of financing a business. So I'm going to cut back to my presentation here, and we're going to just talk a little bit more about payments, credit lines, cash, credit, and how to juggle all of these things. Really, how to sort of optimize for success. And this is going to be different for people at different stages of the business, whether you've got, you're doing, you're paying for Facebook ads or Google ads on your credit card, or whether you've got credit facilities, whatever. There's a continuum of opportunities here, but it's really important, I think, for UA managers to think not just in P&L in P&L terms, which they're sort of wired for in terms of the KPIs, but also this cash flow impact and what ability that has on the business to reinvest and to grow, provided that the KPIs on the user acquisition are being met. So let's just have a look here around credit lines on an advertising network. So let's say I have a Google or a Facebook or whatever credit facility. So I've reached a certain point of spend. Maybe I'm spending 50K a month or 100 or 250, and all of a sudden they say, hey, would you like an invoicing relationship with us rather than a prepay credit card relationship, which absolutely you should always take, because essentially what they're doing is they're taking some of the risk on your LTV cycle. So it just makes complete financial sense to do that. So where we see a lot of people, and apologies, bear with me if this is sort of very, very slow to get started here, but it's really important to think through the mechanics of how these facilities work and how the ad networks look at it, but also how you should look at it in terms of optimization. So typically, and people can have different terms, but typically they're in monthly periods. So let's say it's the 1st of January, and then you've got anything that you're buying. You have $100,000 credit line, whatever. You can spend right up to $100,000, which you get to on the 31st of January. That bill is then due and payable to the network at the end of February, or whatever, end of the month. So typically, it's 28 to 31 days after the end of it. So that's a total, depending on when that bill is due. If you think about the average points, the midpoint of the month until when the bill's due, that's typically at least 45 days, and it could be as much as 90 days, depending on when things are due. So then you go back to kind of break even on the ad spend. So first of all, and what I'm trying to do here is I'm trying to effectively match my assets and liabilities, right? So let's say I've got 30 days or 45 days credit from an ad network. Have I broken even on my ad spend within 45 days or not? And if my ad spend is really short and I've already had the cash payment out from the network, then great. In reality, most people are facing at least 30, 60, 90-day ROAS periods on their ad spend. So already what you're saying is if you just take all of the cash and start spending it, you won't have even broken even, just let alone on cash, but just on P&L terms, until after that bill is due. So you're going to have to find another way to fund it, or potentially you're not going to have the ability to do as much as you want. So again here, figure out your ROAS and then figure out your average payables days. So the very quickest are 15 days from the end of the month. So you have so a couple of ad networks like AppLovin are actually really quick. So payouts from the end of the month, and then Google, Apple, Unity, Vungle, all of these different networks and platforms have got different payout terms. So it's really important not to just know when your bill's due, but when you're actually going to get paid. So you use these financial models and tools to say, look, if I take one cohort and I start here, here's where I break even, here's where I return some money, here's where I get paid. And then you look at it versus a credit facility and say, look, can I use this or can I max it out? But then is there a cash gap? Do I have to look for secondary funding in order to pay off my user acquisition bill? So again, if you look at it on a pure P&L terms, and you look at when you break even on the ad spend and and so on, that's and let's say you've got your bill's due after 30 days and you've broken even on your ad spend within 30 days, let's say. So on a P&L basis, you would think, hey, I'm golden. I've got I've broken even on the ad spend. I can pay off the bill and I can keep the party going. But obviously in reality, what happens is when you think about cash flow, not P&L, it can be lagging your P&L by anything up to 30, 60, 90 days or whatever. So it's really important not to confuse cash and P&L, because what you see typically, what's happening is, companies spending, they max out their credit line, then they don't have enough money to continue spending. So that credit line stays maxed out, and the company either has to use maybe equity cash or cash from a different app or game, whatever, to fund this in order to pay off the bill. Otherwise, the network, if the bills don't get paid, they'll chop you down and effectively stop your UA. So it's really important just to plan out and to build some of these kind of models to show what's happening. So one of the primary use cases for us, and our most typical use case, so most of our customers already have credit facilities in place with Apple and Google. Not all of them. Some of them we fund and they put money onto credit cards, and that's that can work really well as well. But typically, what happens and what we always advocate for is and we'll talk about the capital stack in a second. It's basically like we'd always advocate use the cheapest capital first, and then use whatever you need to do to top up. So effectively, most of our customers have some form of credit facility with a Facebook or a Google, whatever, and they use that and they max it out first, and then they use top ups. They borrow against these receivables that they're accruing as a way of basically keeping the line topped up. So there's always fresh room, and it enables you to keep spending. Again, so I'm getting over my skis. So the LTV is not cycling. You look at the cash, and then you look at the credit facility to top it up. So I think the key thing from here is basically like P&L and cash flow are not the same. And I know because I've been in the UA seat myself in terms of just thinking about, you're very focused on a core set of KPIs, cohort level KPIs that are very much around P&L. And the thing is here to have an appreciation of each other's roles, right? So if you're the P&L focused UA manager, and your colleague is the finance focused finance manager, there's there can be some sort of gaps in language that can easily be sorted out just by collaborating more closely. So think about, obviously P&L and cash flow not the same. Think about reinvestment cycles. Think about, is your UA machine, is it still there, and then how do you find the money together to put into it? And I'm going to show you one example now in a hyper casual gaming, where this can be such an acute problem. It can be really nuts. So if I tab out of here a second, let me pull up this other tab. So this again, just a little tool we built to try and just bring the problem to life. And I remember having a conversation, it was the beginning of last year, it was with one of the hyper casual gaming companies who, it was at a conference in London, reasonably well-known company, mid-size, not huge, not small. And we were having a conversation about, finance and money and hyper casual. And they said, oh, you know what, we kind of like what you do, but there's no issues. We don't have any issues because we get paid out by, let's say, Google and AppLovin, net 15. So I'm thinking 15 days is the only payout delay. That's pretty quick. It's not a big deal. And then in the next sentence, he goes on to tell me that how the recent crop of games they've just brought out have a 5-day break-even period on their ad spend. And I'm thinking this is a complete non sequitur, right? So on one hand, you've got net 15 payment terms, which is actually, if you think about when stuff is sold, it's actually an average of 30 days. And then you're saying that you can break even on ad spend within 5 days. So we put this together just as a really, really simple calculator to say, look, if you had like perfect ability to recycle cash into this formula, how many times quicker could you take them? Let's say you invest, you break even. If you could immediately then take that money out and reinvest it and break even, how many times could you do that same cycle within just one payment cycle of each of the ad networks? So again, it's this crucial focus on how many days to break even. So what we did, so if I go back to his example of 5 days to break even, which is not uncommon in hyper casual, it's a very completely nuts opportunity. Then, so what we're saying here is what we've taken is like assuming X days to ROAS recovery. How many times could I take out the dollar and reinvest it and become profitable within just one cycle? And that all comes down to the payment terms of the ad networks. How long after the ad impression has been served before you actually get the money? So in some cases, I think the shortest here is AppLovin, who's got very short payment terms. You could take the same dollar and invest it in 6 spins around the track within one normal payment cycle. And if you see some of the other ad networks that have got like net 60 days and so on, then here we're looking at 15 times. So I could recycle the same dollar profitably 15 times within the payment cycle if I have the ability to borrow against these ad network receivables. So I thought that was just it was worth sharing that one, because it's obviously a very kind of acute example of use case. So next we're going to talk about a UA machine. And this is a concept we kind of developed. It's obviously, like most things in life, very, very simple, but it's a concept we developed working with dozens of developers over quite a long period of time, and helping distill, we're just separating the wheat from the chaff and helping distill down what really matters here, and then how to think about UA in a from a financial perspective. And just have real sort of clarity of thinking, because UA is nothing more than an investment equation. And so and this is like, distilled thinking down into just 3 really, really simple things. First of all, do I have a machine? And by the machine, I mean, do you have a formula where you can invest money and you can break even, and then you can make some level of profit? Can I turn $1 into $1.20, $50, $2, whatever, over a period of time? If I can do that, then that's great. And that's the first thing. And that actually, for a lot of people, that's the hardest thing to get to, because most people are just not able to spend profitably on ads. So first of all, do I have a machine? If you take that one, then you go on to the next one of how do I fund my machine? So basically, I've got a machine that I can put $1 in, I can get more than $1 out with a reasonable degree of certainty within a known time frame. So how am I going to fund it? And then 3, on the basis that the world has finite people and resources and all the rest of it, I cannot just scale this thing linearly to the moon, and there's going to be some external factors that suppress my ability to keep continuing at this pace. And therefore, with unlimited capital to put into it, at some stage my machine's going to be running at full capacity. That's either a certain amount of spend per day or per week or per month, or certain number of users acquired, or whatever it may be. So how do I think about those things? So I'm going to go back to the concept we spoke a little bit about, which was the capital stack. So on the basis that you've figured out together, we figured out as a UA manager, it's like, I've got this this machine, and this machine works. So how you're going to fund it is a joint problem for the finance team and the UA manager. And dispassionately, what you should do is think about it from just a really, really sanguine perspective. So I'm going to use my cheapest source of capital, and I'm going to go through the various different options that may get more expensive until it doesn't make sense anymore, because either I can't meet a minimum hurdle return, or my UA is unprofitable, or whatever. So let's start off at the top of the stack. So if Facebook or Google or whoever is prepared to give you a credit line, take it, use it, and for as long as your UA is working, max it out, because they're effectively, it's a risk transfer from you onto them of part of your LTV recovery cycle. So that's the first thing. It's free money, take it. Next, cash at the bank. So if you've got a bunch of money just sitting in your bank account earning you 0.25% per year because interest rates are so low, and you don't mind deploying that capital into your UA cycle where you might be able to make 10% a month, instead of 0.5% or 0.25% per year, you should absolutely do that. Now, there may be reasons why you don't want to do that. You've just raised a bunch of venture capital and it's sitting there for developing product, or you have an acquisition war chest, or you just don't feel comfortable running that close to the wind and you want just a cash buffer in the bank. All of those totally valid. Credit cards is in there. We used to see it a lot more. We don't see it so much recently, where people would play the interest-free payment terms on their different credit cards. Again, it just became too difficult for a lot of people, because what would happen is credit cards would max out, the campaigns would get dropped, and it would take several days to get them back up again. So most people said, you know what, it's nice for the air miles and a bit of interest-free credit, but it's on balance, it's kind of too risky a strategy. So that's less of a thing. Credit facilities, which are like the facilities we provide, the link to accounts receivable and allow you to borrow against this asset to reinvest. There's really another one. I'm going to redo this diagram actually, because you now see a few people doing revenue-based loans. It's like, I'll lend you a bunch of money and I'll take a percentage of your revenues until I've been repaid in full, plus an extra percentage on top. Certain reasons why, for a lot of gaming and app companies, that doesn't really work, particularly if it's freemium. It can work if it's subscription. Typically, it's more expensive than a receivables credit facility. And so that would sit in between lines of credit and then VC funding right at the bottom. And still to this day, it's staggering the amount of people that raise money just to invest into user acquisition when they don't need to, or at least they don't need to raise as much. So we have we actually get a good amount of our deal flow from different venture funds who want their investee companies to be more efficient with the capital, which improves everyone's return. It improves the fund's return. It reduces the founder's dilution. Everyone's kind of happy. So that's the capital stack. And the way to think about it, again, just very, very simple. So, let's say I turn $1 UA spend into $1.60 over a 3-month period. So I have a 60% return in 3 months, or I have a 20% month-on-month return. I always need to compare things on the same time frames and side time horizons. So I've got a 20% ROI on my ad spend. Now, let's say you could put $1 in, or an unlimited amount of dollars, and get that 20%. The problem is you don't have that dollar. So if you go out and have to borrow the dollar, and financing rates typically lower than this, but just keep the number simple. So let's say it costs you 2% to borrow that dollar to invest it and make a 20%, then your profit from that trade is 18%. So the smartest people that we've worked with are super focused on just the profit, as opposed to headline costs or debt versus equity or whatever it may be. Very, very focused on the profit mechanic. Now, what will happen is when you focus just on the investment, the return, cost of capital, return on capital. So let's say what will happen is, as you start to scale, you start off with, let's say, a return on investment of 20%. But if you go from 1,000 users a day to 5,000 to 10,000, whatever, there's two things going to happen. Your returns are going to go down. Your LTVs are going to go down for sure. So let's say you increase, your return goes down from 20 to 15%. And then you look at your cost of capital, which actually, the more you borrow, it also goes down, which is good news. So let's say you're paying your 20%, you're paying 2% to make 20. Now you're paying 1.5% to make 15. Again, when you focus on the profit, you move from 18% to 13.5%. So you're not making as much profit, but you're doing so at scale, or at bigger scale. And again, you're trying to maximize your profit here. Now, you'll have maybe hurdle rates, whatever, that impact into this, but it's an interesting way to think about it and model it. So then, when do you know if the machine's running at full capacity? And you've got, this is back to just demand economics 101, demand and supply of users and cost of mobile advertising. So what is absolutely sure as death and taxes is that as you acquire more users, your acquisition costs are going to rise over time. Now, how much they rise over time is going to depend on the genre, the addressable market, all sorts of different things, seasonality, all sorts of different things. But let's just keep that as a simple assumption. The next thing that's going to happen is LTVs are going to crest, fall as you scale up. So if you go and you buy like your super users, your people who can't live without what you do, you're going to go out in concentric circles about people whose propensity to spend is, yeah, it's there, but it's less than the real super users, and that's going to bring your LTVs down. And this is looking just like demand economics 101, demand and supply curve. Now, what's going to happen is you don't know the shape of those curves. So unlike your first ever economics lesson, it's not a straight linear relationship between demand and supply. And the trick and the art form, and I don't have too much to offer here, I'm afraid, because it's a bit like staring into the crystal ball. It's trying to model the shape of what these curves look like for your app, your game, your business. So take something that's super niche. What's going to happen is acquisition costs are going to rise. They're going to go exponential pretty quickly because there's just not enough people in the world who are interested in what you do. And if you've got Facebook targeting algorithms, whatever, searching down these people, there's just not that many of them. So net result is going to go super high, super quick. Contrast that with something like hyper casual gaming, where you could up your bid by 2 cents a user, whatever it may be, and then you could have another pool of 10 million people that come onto it. So it's much less targeted, it's much more kind of generic, and therefore you're going to have a much flatter curve. And then also the same for LTVs. You just don't know, you just got to keep modeling it every day. This is not set and forget stuff. And then you figure out what, so economic theory says that you should buy all the way up until your marginal cost equals your marginal revenue, which is how to maximize profit. Now, this is not such a theoretical world, and I think most people here are going to want to have some minimum target return on investment on their ad spend. Is it 5% a month, 2% a month? It doesn't matter what it is, but you'll have hurdles to hit. So essentially what you do is you would continue to buy up to the point that it doesn't make sense because you just can't meet your minimum hurdle return. Or more than likely, if you get your numbers and your plans off, then you could be underwater in your UA spend. So you want to maintain a confidence level that allows you to keep spending, but like the responsible gambler, you'll step back at the right time. And then lastly, it's so important. We've seen people like not look at these things from week to week and be absolutely hosed. So the whole point is like you have to have as part of your daily processes a way of just checking, looking at the early ROAS. Are you on track to deliver? And again, there's not a sort of a rocket science way of doing it, but it's just a real laser focus on those numbers, having the right internal kind of reporting frameworks and so on to just constantly be on top of it. And don't be afraid if something's not working. Don't hope and pray that it's going to. The early indicators are if it's not working, it's more than likely not going to work, and that could impact your returns down the line. And last thing, and this is something we're really, really hot on because we've seen it done really well and we've seen it done really badly as well. And this whole thing around the intersection of finance and UA, take time to work with your colleagues. Maybe you're like 6 people in the same room in a WeWork. Cool. Then, in fact, that makes it much easier because everything is everyone's problem. But sometimes the bigger the company gets, you'll have different people in different functions. And it's very unlikely that the finance guys are really going to take the time to really understand UA, like the UA managers see it and smoke it and chew it every day. And by the same time, try and take the time to figure out what the finance managers' criteria are, what they're focused on, and try and solve the problem together. Number 2 takeaway: forget about the idea of a marketing budget. It's a complete fallacy if you want to be doing this properly. The question to ask is not like, did I spend my budget properly? It's like, if this UA well is open for drinking, if the UA machine is there, then how can we together, finance, UA, founders, VCs, whoever, but everyone around the table, because it's a collective responsibility to maximize the UA opportunity for as long as it exists. So it's not just about a certain budget, spend it, use it, lose it, whatever. it's about figuring out whether the well is open for drinking, and how to maximize the opportunity collaboratively, as opposed to thinking in a siloed kind of job spec type of way. So that was it from me. I see a few things sort of popped up in the chat. I'll try and sort of get through those, but hopefully that was interesting for you guys, and I think we've got a little bit of time. James, I see back on now. So you tell us how long we've got, and if we've got any questions.
We've got a bit of time. Do you want to stop your screen share, Martin, so we can see your
yes,
wonderful face?
Sorry, give me one sec. My cursor just disappeared. Here we go.
Okay, great.
Right.
So do you want to, should I field the questions for you, or do you want to pick them up?
Where am I going to see them?
That's okay. I'll field them for you. How about that? So, okay. So we have a question from Simon, and he is from Amazon, Audible rather. Sorry, from Audible. Simon is asking, how do the metrics you look at change for subscription apps or services, e.g. average revenue for daily active users? Is that still relevant?
Yeah, so the answer is they do, and we've done some work around modeling those and then modeling the cash flows out. So it's probably best to kind of reach out directly. I mean, what we were looking at here was metrics for freemium. Where you've got subscriptions, it's going to depend on the plans, on the churn of each plan, and you make some assumptions and some models around that to try and project out. The underlying concepts are the same. The good thing about subscriptions are it can be an absolutely killer formula where you've got, if you get people buying long dated subscriptions, and you've got, modest-ish acquisition costs, and you can get huge cash inflows that can then enable you to really kind of to ramp up. So we've had some, we'd worked with some dating apps and so on, who people were buying 1 year subscriptions. They were able to take that and then roll that up into into very substantial kind of user acquisition spend. But yeah, the metrics are different. But if you want to reach out offline, whatever, connect through Swapcard or whatever it may be, we can absolutely run some scenarios on that.
Great. And Alex Gitlin from CallApp is asking, he's head of growth at CallApp. He's saying, any recommendations for developing an LTV model for apps that strictly monetize off apps, not off ads, sorry. eCPMs change daily and seasonality plays a massive point.
Yes, and so what we went through, what we have on there is very useful for a snapshot. But you're right, the CPMs can go wildly up and down. It's going to have a direct impact on your UA cost, which is why, in certain ad monetized game genres, particularly app genres, it's really like a day-to-day thing. It's almost like does the opportunity exist? What am I getting? Therefore, what can I afford to spend? So modeling that on an LTV basis, because there's a lot of unknowns in the equation. You've got an eCPM range between X and Y, and therefore it's very hard to build a financial model that's, unless you just are so pessimistic about it and then everything else is upside. But it's really sort of, what you want to be doing is building a dynamic model that is basically monitoring these things on a daily basis, and what budgets you can spend on a UA. I mean, maybe it's not quite day to day, but it's definitely week to week. What your spend limits should be based on what kind of monetization horizons you're looking at.
Okay, and we have a question from Sophie at Zoopla, well-known property app. Any recommendations for modeling LTV on an app that doesn't go strictly off revenue returns, but more user engagement, value of key events? I guess a search for a house or connection with an estate agent.
So it's like in apps and games where you have a digital revenue stream, it's pretty easy. It's pretty closed loop, right? Because all the money's being made on either Apple or Google, or it's been made through the ad networks. Where you've got a real life LTV, and that could be from is it a house sale? Is it advertising revenue based on that? You know, there's lots of stuff in the real world to model. It's notoriously hard, and there's not some one kind of one size fits all. I think what is useful is to really understand the things that are important for the business. So is it retention? Is it you know, are you able to price the cost of the ad units on retention of, and the number of sessions per week or per month when someone's looking for a house or whatever it may be? Yeah, I think it's really important to brainstorm the key things that drive it, and then see if you can build a rough model. But modeling real life LTVs, whether it's e-commerce or it's anything that's kind of offline or done outside the app stores, is a different beast.
Great. And I have to ask, how is the IDFA iOS 14 going to disrupt all of your lovely, you know, models and tools and calculations? And
well, I don't think it's going to disrupt the models and tools and stuff. I think it's obviously there's potential to recalibrate a lot of stuff on the you know, in the advertising world. I know a lot of, you know, there are a lot of people playing a wait and see game, right? So I'm not gonna try and offer up some real pearls of wisdom, because you know, there are people way smarter than me to talk authoritatively on the subject. What I do know, just from what I would suggest, is you can't halt progress, and smart people are smart people, and people will figure ways to do. I mean, we're not going to go back to the days of unattributed billboard advertising where, you know, 50% of your advertising revenue is poured down the drain, right? So we've come too far. There will be a recalibration. The dust will settle. The new trajectory will be set, and the underlying principles will be you know, the same, maybe partially improved. Maybe there'll be some winners and losers. I mean, I think it's inevitable, but maybe there's a bit of rebalancing in terms of UA networks, and you know, a little bit more competition in the field, perhaps.
Great, good. Okay, one final question, Martin. One of my colleagues wants to know whether he can get a gilet like the one you're wearing. Is this a Pollen branded one, or?
It's not. It's actually a birthday present from Uniqlo from my mum.
Oh, Uniqlo, right. Very nice. Yeah, well, good choice from the, yeah, good. All right, Uniqlo's the place to go. So there you are. Yeah, good.
So if anyone wants to hit me up for any either fashion tips or user acquisition advice, you can reach out over email.
Right.
Martin@pollen.vc.
So Martin@pollen. Oh, here we go. We've got one more. Let's have one more question, Vladislav. Any of your here we go. Do any of your clients work with marketing data analysts using prediction models?
No, those are things. So, well, actually, there's two things I see. What are your best case studies?
Yeah.
So probably the best one we had was working with the guys at Pixonic in Russia a few years ago. We've actually got a new one, which will be out on our website within the next couple of days. I've just seen the final cut of it. So we're starting to do a bunch of video case studies. It's one of these things. It's hard for us. Sometimes we want to stay under the radar and just be the guys sort of financing, and then sometimes it's useful to have some you know, some people kind of on the record saying nice things. So sign up on the website, and we've got a new video case study to publish shortly. And the second question: do any of your clients work with marketing data analysts? Prediction models in UA. I mean, yes, like some people try to do this in house. Some people hire in experts to do it, and it's one of these things that the freelance or the agencies, if they're really specialized in it, the knowledge of working with lots of different people, you know, fuels their overall kind of knowledge. Prediction models is very interesting, and we use some of our own predictive stuff in terms of LTV. We do like a cohort level LTV analysis. So you know, the more times you throw the ball out the window, the more times you can predict or the better you can predict where it's going to land. So I think, yeah, it depends on how long the LTVs. If the LTVs are really long, using predictive models and so on can be dangerous, because you might be able to mess it up. But I think they're an important part of the mix. I don't think it's anything that someone's really cracked yet, because there are so many variables. But yeah, it's a space we like for sure.
Great. Well, thanks so much, Martin. And yeah, hope to see you in person soon.
Yeah, very much. You can see my gilet in real life. Thanks, James. Thanks, everyone.